day, that hustle.
Hustle House Podcast.
What's going on, everybody? Welcome back to Hustle House Podcast. Today, we're at the rooftop over here at Pismo, overlooking the nice ocean right here. The sunset's coming down. So today, who we have here is Vic. He actually does all of our loans for all our real estate deals. So if you need anybody that's super knowledgeable, been around for many, many years, and basically he's going to have all the answers to any questions you have, make sure you hit Vic up because he's going to be able to provide all the answers, all that good stuff for you. And without further ado, it's my boy.
Well, I appreciate the introduction there. My name is Vic Kirkari. I'm with California Mortgage Solutions. Been lending for 25 years in the area. Predominantly, we've been doing conforming and all your FHA, VA, Govy loans. Here lately, last few years, we've kind of transformed into this new phase of ADU financing, and which is how I came across meeting these guys as investors and seeing how much that they've grown in the short time that we've known each other, and watch their portfolio just grow exponential. Like, I don't even know, like 500, 600, 700%, you know? And the cash flow these guys are generating is just awesome. So.
Well, it's all thanks to you, bro.
Yeah.
Honestly, like your knowledge and the shit that you've been able to provide in the lending industry has helped me out a lot to acquire these properties. Because in the beginning, especially as a real estate agent, you're 1099, so you write off a bunch of shit. So a lot of times you're not able to qualify for a purchase of a home. But thanks to you and your creative ways of financing, I was able to buy my first one.
Right.
And then from there, you know, right now I'm at eight properties.
At
least eight, yeah. With myself and Raul.
But yeah, right.
And then Premier is a whole nother, whole nother game. But what made you want to get into lending?
What made me want to get into lending is when I first got into real estate, I wanted to actually do somewhat what you guys are doing. I wanted to be a land developer. I wanted to build homes. I even had a name picked out. When I was going through Cal Poly, I graduated from Cal Poly here in San Luis Obispo, and I had a company that I wanted to start called Syndications. And syndicate is something that's really big, right? Like it's a group of investors or whatever. It's a syndication. And I wanted to start something named Syndications. But what we did was we built land developments, right? So when my family migrated here to the U.S., and one of the families turned into building homes, and I saw how they grew, and they grew so fast. They ended up on the NASDAQ as a stock, you know, publicly traded stock. And they're the third biggest home builder in the U.S. now. And they're one of the biggest in international. So
that's part of your family, you say?
Yeah. Well, not direct family, but indirect. But my family first moved here from Iraq. They came over around the same time. I had cousins working for them when we were young on the East Coast where they started. But then when I saw that, at a young age, and my parents migrated here, they all lived in the same house together, you know, with my uncles, aunts, everybody. And then they each started buying houses, and then they each started buying rentals. And back then you would have to put an ad in the newspaper to get, your rental rented, right? So, and I was a little kid, and basically the phone would go off the hook.
Yeah. I
was born in San Luis Obispo, California, raised in San Luis. And every time that they would put an ad in the newspaper, literally the phone would ring for a week straight. And in my head as a little kid, I figured, wow, if I could rent each one of these people a house,
rich.
Right. And so it's always been a thing of me of what I wanted to do. So going through Cal Poly, going through university and learning the right way to do it meant a lot to me. So going through Cal Poly is what got me into finance, to answer your question. It is basically, I went through Cal Poly and I learned the key to doing everything I wanted to do was figure out the financing for all of it, right? Like figure out how to finance your projects or how to get that land development deal or that rental home or whatever it may be, right? Because without the financing, you really don't have anything. You know what I mean? You can't,
100%.
It's an idea, right?
Yeah.
Until you can, the financing's gonna act on that idea, right? And then if you can figure out like what you guys are doing, how to come up with the cash flow and make the payments of that financing, you can just grow as fast as what you guys are doing right now, you know? And that's you know, the important part is just keep grinding and doing it, you know?
Yeah, I had a conversation with Eddie about like how important funding is. Because in the car business, for me, like the guests could like the car.
Right.
They could love the payment. They could
Right.
love the sales consultant. They could love the place. But
Right.
if we can't get you approved,
Right.
it kills the whole deal.
Right.
Right. And then I remember talking to Eddie about it. It's like, bro, financing is so important.
Right.
So when I first spoke with you, the very first time you helped us with Jewel Street,
Right.
and after I got off the phone with you, I told Eddie, I was like, bro, this guy knows exactly what he's talking about.
Right.
Because you just
Well, I
know,
appreciate
bro,
it.
like
Yeah.
when you're talking to
appreciate
someone,
it.
they're explaining everything.
Yeah.
And I've been in the car business for 6 years. So I talked to a
Right.
lot of banks,
Right.
and they explain to me like the guidelines and stuff,
Right.
different things that they want in order to
Right.
get a deal approved.
Right.
Whether it be like a I-10 number or
Right.
like legitimate social, or
Right,
work
right.
social. It doesn't matter. There's
Right.
different ways to get different people approved.
Right.
So when you were explaining it, I was like, bro, this guy knows exactly what he's doing.
Yeah, I appreciate that.
So, because
Oh,
some
yeah.
lenders, they don't really
Yeah,
know.
they're in the box.
Yeah, exactly.
And it's like
Not
this-
only on the financing side, but you also invest in yourself.
Right.
You know, you own rentals, you've done fix and flip, you've done development projects,
Right.
so you know the ins and outs of that.
That's what
aspect of the
helped me
business.
with growing into financing. Why we're all friends and why we're doing so much business is I was just a conforming loan. Like if you wanted to come to us, we would get you that conforming loan or that FHA loan or that VA loan, which got you to buy your home or
Yeah,
your
your
rental.
personal home.
Right.
Yeah.
But it was all the investing and figuring out, wow, you can only do so much of this conforming loan or Govy loans is what we call it in the business to purchase these investments. Right. And they actually cut you off at like 10 properties. Right.
Yeah.
So then we had to start getting more creative with how can we figure this out and just keep going? Cause like it's making money. Right.
Yeah,
So, and investors want to make money. So how can we keep going? And that's why we brought all our private money investors in. We brought in all the different products that we brought in just to help people grow and develop property or build ADUs or buy their rentals, you know what I mean? And build the cash flow, right? So, but I mean, it's also like a give and take because it's not just me. I've learned from you guys too, like what you guys are doing. I mean, you guys are buying these ADUs on a rehab loan, right? You're coming in with the 10% down. You're turning that 10% into a 3-unit property. Now, if you're going to use a conforming loan, right? And you're going to buy an investment property on a conforming loan, you're putting down 20-25%.
Yeah, easily.
And you're getting a crappy rate. You're paying the fees,
And
right?
you're not getting
And-
funds for the
and-
ADU.
They want to see your assets, right?
Yeah.
They want to see a ton of assets. They want to see all the money, where it's been for 2 months, right? How are you going to make the payments? If you can't make the payments, which, you know what I mean?
Yeah,
They're going to put you
exactly.
through the ringer to get that loan, right?
Where'd you
the
get
ti-
the money?
Right.
You know,
So,
you
Yeah,
so,
where'd you get the
so
money?
now the financing that we're offering, which is working good for our investors and for everybody is because a lot of guys like you too, sometimes you might want to bring a different partner in that has the money, right? And we don't have to go through there and basically be like, where'd the money come from?
Yeah.
Right. So the financing now, and the funny thing is it's less money down.
Yeah.
You're putting down 10% instead of 20-25%,
Yeah.
right? And you're getting money for the rehab and the reason why we're doing 100% of the rehab, we give you 100%. It sounds like a sales pitch. Hey, you buy our use us for the ADU, come in with 10% down and we're going to give you 100% of the financing. It's great, but it's to protect both parties, right? It
Yeah.
protects you,
Mhm.
but it protects us also.
Because
right?
you want
That
us
way-
to
that way the
succeed.
job gets
We
done.
want to make sure you're going to finish your project,
Yep.
right? So if we're doing 100% of the rehab, you're going to finish your project,
Yep.
right?
Yeah.
And then what we're going to do is we're going to roll you into what Eddie knows a lot about is these DSCR loans, right? So these guys are coming in, they're buying properties for $300,000-400,000 grand, right? We're giving them a $500,000-600,000 loan. They're rehabbing it. They're turning it into a 3-unit property. And then they're refinancing at 75-80% cash out on DSCR loans, right? And they're taking $200,000-300,000 when they're done. They only put 10% down. So now they're net positive $250,000 in cash, right?
And we're cash flowing.
The property's cash flowing because it has the cash flow to get the DSCR loan, right? And then they're using that money to buy 3 or 4 more.
Yep.
And it just grows.
Yep.
And it's been very successful and very lucrative for everybody involved, you know? So, but it was help working with guys like you guys, right? To help me see that, hey, yeah, this is a perfect model here, right? To help people get in for cheap. They can't get in this cheap with conforming loans. and then they can pull the cash out and do it again and again and again. And I mean, watching you guys and grow to, bro, when you say 8 properties, I'm saying, yeah, maybe with one of your partners, you have 8 properties, but I mean, wow. I would say that there's probably 12, 13, 14, 15.
Yeah.
And like the last 2 years.
Yeah.
You know, so, which to me, I like that. You know, Eddie comes from a great family. I like to see that, you know, and it's a trickle effect, because not what you guys are doing is keeping us busy. It's keeping you busy, but it's keeping your contractors busy.
Yeah.
It's keeping everybody busy. It's what's driving the economy. They always say real estate is 60% of the economy, but you guys are like in a micro level doing what the whole nation does in a macro level.
To add to the 60.
Right.
Yeah.
And you can see 60% comes from real estate, right? Because think about every time you buy a house, the escrow companies, you're paying people's wages, the lender, the insurance companies, the contractors, you know what I mean? You guys are making money, right?
The reports, the home inspectors.
Right. Everybody. So the appraisers, everyone's profiting
it
from
makes
this.
everything work. So
Right.
I've had guests in the past tell me, oh, you guys are making money on me. It's like, well, yeah, it's a good thing to make profit.
Right.
Because if we weren't making profit from each other when I go get lunch, when I go buy a drink, when we do business, we're not going to have a good economy.
Right.
Because nobody's making money off each other.
Well, and, you know, going through Cal Poly, one of the majors I did was economics. And I tell you, one of the things we learned in economics is there's no free lunches.
No.
You know what I mean? There's no free lunches.
Yeah,
If someone's offering you a free lunch, it's not free.
No, it's not free.
Right.
That's why, so Eddie's been my realtor for all my properties that I purchased.
Right.
And I've had people that I have friends that'll be like, oh, so does he give you a better deal? I'm like, no. He's like, you don't even ask? I'm like, why would I ask him to give me his services for less?
Right.
Like, that's not cool. Like, he should get paid all the money because all the value that he gives me. Like, there's so many questions I have that I have no clue.
Right.
And he just handles it.
Well, and I've worked with him on a lot of deals. It's not, at real estate, it's not one of those things that you're going to lowball or get a better deal on a realtor. But when you have good representation, and I've seen what he's done with his clients. I've done a lot of the loans for his clients, and the representation that he gives and the things that he looks out for that normal people normal realtors that are just looking for their check aren't looking for, because he's bought the houses, he's built the houses, he's opened up the walls and seen the termites. You know what I mean? He knows what could happen. And I think that's what helps you also is me being an investor which how it helped me in lending, I think has helped you being an investor has helped you in real estate and helped your clients as well, you know?
100%.
So
all my clients that want to buy rental properties, I know the game. So it's,
right.
You know, if they went with another agent, they would just sell them any house.
Right.
For me, it's like, I want to make sure that it's going to make sense for them, because I want them to be successful. I want them to succeed in real estate and continue buying houses for me. You know,
right.
Hey, that's what's most important, is to have them become successful. So that way they continue to use
It's not a short-term relationship. You're looking for the long-term relationships, right?
Exactly.
And you understand what a property is going to generate in rent. You're not just going to be like, yeah, I think you can get that. You know, you actually do it.
I know,
because you do it.
And I'll take them to my personal properties. Hey, look, this is what I'm working on. This is what I rent this property out for.
Right.
This is how much I spent in renovations. But I wanted to ask you a question, because you've been in the industry for a long time, and you experienced the 08 market. Right. You know, the market crash.
Right.
And I know before that you were doing a ton of business. You were killing it in the mortgage industry, and you were even doing flips, right?
The golden age, yeah.
You were making a ton of money flipping properties. So I wanted to get your advice on, you know, if that were to happen again, what would be the best thing to do to protect yourself from a situation like that, an 08 situation? Protect
yourself as a homeowner,
as an investor, and to make sure you don't lose money.
So back in 08, I could tell you the people that lost their homes the fastest were the people that were living outside their means. The people that kept refinancing, calling us every 6 months, every year,
just to pull money out.
So they were making $100,000 a year, but they had a $300,000 a year lifestyle, right? So they're refinancing. They were living off their equity. They're buying the boats. They were staying at hotels like this, and you know what I mean.
Yeah.
But they were making $100,000 a year, which so I don't know. But they're basically live within your means.
Okay.
don't pull any more equity out than the property could support, right? And when I say that is like, just because you can pull out, you have $1 million property, you can pull out at 80%, which is an $800,000 loan, right? But if God forbid something happened, you lost your job, you have to rent out that property, but it only rents for $4,000 a month. But that mortgage payment for $800,000 might be like $6,000 a month. Don't do it.
Yeah.
Right.
Then you're going to be under.
Right. Do it to where the property can pay for itself. And if you live within those means and live within your means as a what you do for work, right, you're going to be successful. Right. And basically that back in 2008, it was so easy to give anybody a loan. I mean, there was field workers that were coming in and getting loans that were $800,000-$900,000 loans, and they were field workers, right? So, but all that they had to do was sign. They're all doing these liar loans, right? Where we didn't have to get any income documentation, any assets or anything.
Bro, that's the crazy part. That when I heard about that, I'm like, whoa.
Yeah, no,
like,
it was
income?
crazy. Yeah,
Anybody could just freaking get a house.
It was a crazy days.
So, do you think that's the predominant reason why the market crashed like that?
No, it won't. I don't think it'll ever crash like that. And I'm not, no promise, no guarantee. I don't have a crystal ball.
Yeah.
Sometimes I think I do, but I don't, right? But I don't think it will ever crash that hard again. And this is why. Back then we did liar's loans, right? People couldn't really afford the payments. They were interest only payments on primary residences, right? Which is against the law now. Right. So now in a primary, you need to have a fully amortized payment, right? Principal and interest. Back then it was interest only for 2 years. They were 2-year arms we were putting everybody in. And when the recession started, interest rates went from 5%, 6% ranges where it was about 06, 07. And then in 08, 09, it jumped up into the 8s and 9s, like where it is now. Right. So when it did that, people were in arms. So their payment went from interest only at 5 or 6%, which they had a $2,000 payment, right? And then it went into a fully amortized payment that was 8.5%, 9%. So their payment just went from $2,000 a month to $4,500
overnight.
Oh, yeah, basically within 1 month is $2,000 and the next month it's $4,500. And they were just like, what, And so, and it was actually a really hard time to be in the mortgage industry and answer your phone. Because these are people you care about, right? Yeah. These are the people that call you and thank you, telling you that, hey, thank you. I never thought I could buy a house. And that was so much gratifying. And so it made you want to help more people, right? As many people as you could, because that made you feel good. You know what I mean? It was like high to get that phone call. I loved it. You know what I mean? But then going through that crisis, it made you not want to answer your phone, right? Because everybody was like, hey, what do you do? What do I do? But now people are in a fully amortized payments. We don't really do interest only payments unless we're doing the short-term bridge financing, right? Yeah. But if you're doing any type of real 30-year loan, their interest only is rare. I would say it's 3% maybe. 97% of loans we're doing now are going to be fully amortized and they're all fixed for 30 years. So that you're not going to get that payment jump. Yeah. The only thing that's going to happen is if the rates go down, hopefully you're in a position where you can refinance and get that lower payment, right? Yeah. And so it should help you. So I think it won't get that bad, right? You never know, right? But the forcing people in a 30-year fully amortized loans, I think that they're qualified for too, by the way, right? Yeah. This time they're qualified. We're qualifying with their taxes, their insurances. We're looking at the full debt, everything. Now we have to even look at, hey, and you have lenders that are asking you questions like, why did you have your credit pulled 6 months ago?
That's funny because I got that question asked to me.
Right. Well, it's because it's our duty as a lender to make sure you didn't get any new debt that's not popping up on your credit report. Yeah. So now the pendulum changed, right? So now it's on us for the responsibility to make sure we're using all your debt that you have properly. We're properly calculating your debt to income, right? We're properly calculating your income. We're properly putting you in a mortgage that's not going to change on you. And risk factors that doesn't have any high risk factors is what they're called. And it's not going to be like interest only or anything like that where it's good. Once that interest only period's
Jumps
over, it's
up.
going to balloon on you, right?
Yeah.
So I think the combination of actually having qualified buyers, having conservative financing, which is if you can afford it now, you should be able to afford it the whole 30 years. God forbid anything happen with your job or anything, right? Oh, and hopefully the idea is when rates go down or whatever, you're in the opportunity to be able to get into a better loan, right?
So Eddie and I had a conversation about that. We're like, man, these high rates, there's still opportunities out there. In
Right.
fact, like if we buy now and we have that 7.5% interest rate,
Right.
once it comes down,
Right.
the value of the house, I mean, you're talking about millions of buyers coming in the market
Right.
again,
Right.
ready to
Value's
buy.
going
Right.
up. Not only that, if we're cash flowing now
Yep.
with the high interest
Imagine
rates,
then.
You're
imagine
going to
when
cash flow
we
better.
refinance.
Right.
Yeah.
Well, and then that's what they say also is if you're buying, like you guys are buying for income, right? And Eddie and I talked about this last week. It's never a wrong time to buy an income property, right? So if you're buying for income, it doesn't matter. If you're buying short term to try to flip it, that could be market sensitive, right? But if you're buying income property, right?
Never,
And
doesn't
you're
matter.
buying and the market crashes next month, but you have it rented and you're in a positive cash flow situation. It doesn't matter if that property went down to 500 grand. You bought it for $1 million and went down to 500 grand for 5 years. And then it went up to 800 grand in 10 years from now. But 20 years from now, it's $2 million. The short term ups and downs don't matter if it's income property.
Yeah. Grant Cardone said the same thing.
Oh, they
Because
did.
he's all like, I don't care if we're in an upturn, downturn. There's only one thing I care about is the property cash flowing. Because whether I'm under or above, you name it, because it's going to happen. The only thing that I care about is cash flow. And you literally just explained exactly what he talked about.
Right. Well, I learned it personally because I was in the mortgage industry in Santa Maria when I first started, in the early 2000s. And then I came into San Luis Obispo, and the whole time I'm making all this money and, you're going out, you're having a good time, but I wasn't really buying in properties. Right. And so I was just paying Uncle Sam. Another thing people don't understand is properties are such a good tax write-off.
Yeah.
Right.
They're great. tax
So, and my accountant actually told me, hey, you need to start buying some houses because there's some big checks being paid, So I'm like, okay. So I just started buying houses in 05, 06 in the peak of the market. And then the crash happened in 08, right? And then I think my last one I bought was 07 at the very peak. And so, and everything crashed. And as like everything I had bought, yeah, I mean, if I want to kick myself in the ass, but I could have bought it for 30 to 40% off, right? If I would have waited 2 or 3 years. But now it's been 15 years since then, and everything's worth so much more than what I bought it for. I could just sell it all and live a great life. You know what I mean? But so the short term really didn't matter. Even if I bought at the worst time, which I did personally, I bought 4 properties at the worst time you could buy a property. But now I can look back and I'm glad I have all those properties because what they're worth now is, bro, some of them are worth like 500-600% more than what I bought
Especially
it for.
back then.
Oh, fourplexes, apartment complexes in San Luis Obispo. Yeah.
Especially
Buying in
yeah,
the
San Luis.
sevens and 8s in San Luis.
Oh, dude.
And I mean, those things are worth $2.5 million now, but for a while they had dropped from what I had bought it for. So if I would have kicked myself, if I would have bought them in 08 or not 09, maybe they wouldn't have been for sale in 08 or 09. So I can't beat myself up. Right. But if they were, they probably would have been worth less. Right. So the short term might have been a bad investment, but now 15 years later, I look back, those properties cash flow 400-500% more than what they did when I bought them.
And they were cash flowing when the market crashed. They were cash flowing.
They
breaking even,
they
or-
were breaking even,
Okay.
it was breaking even
But
back
it
then.
was breaking even from the get go.
you were able
From
to,
the get-go back then, see, I've learned a lot. See, and that's why I appreciate you guys. You guys actually are a lot more intelligent than I was when I first started investing in real estate. Back then I was buying because I was making so much in mortgage. I was buying it more for the tax write-off because my accountant told me to.
yeah.
So I didn't pencil things out like you guys do, right? I mean, Eddie, every time I talk to him, and even Raul, and you do a lot too, is you pencil out, hey, I can rent it out for this. So hey, what's my payment? Well, this is that. How much taxes? You guys are breaking everything down before you get into it, which I never did anything like that. I'm just like, oh, that's awesome.
I'll buy that.
Apartment complex on Murray Avenue in St. Louis. Yeah. I could buy that. Okay. Yeah.
Yeah.
You know?
Yeah.
It was, I was a different person then. Right. So I was buying it for the loss. You know what I mean? But which isn't always
But hey, it worked out.
right. Yeah. And then I had a very savvy financial planner tell me, never buy property for the loss, for the tax loss. But to be honest with you, you can listen to this person over here or this person over here, right? And everyone's situation is going to be different. And at the end of the day, it's a combination of what works for you. If you can get into a positive cash flow property, that's the best way to do it, because you can always write off depreciation and other paper losses for those properties, right? And the depreciation can be written off in, instead of a 25-year, 7-year or 10-year, depending on what the account wants to do, how long you want to hold the property. Some of these, like the ADU financing, right? A lot of these guys might only want to hold it for 5 years. So they'll do a 7-year depreciation or a 10-year depreciation where they're not paying a lot of income taxes on that rental income, right? On the positive income, because they plan on 1031 exchanging it in 5 years, right? So it's like, why would you want to do a 30-year depreciation schedule or payment, right? Because if you do it, they're only going to let, when you buy a property, the way the depreciation works is like, what is the cost basis? Like the land was worth this, the property's worth this, right? You can raise that cost basis by doing improvements like floors, roofs, windows, whatever, right? So you can keep raising that basis. But whatever you raise that basis to, you can depreciate over X amount of years, right? So people that are wanting the 1031 exchange, which is another great tool in investing, to where you could sell a like property for another like property and defer those taxes, right? People that are planning on doing that, jumping through these loopholes, are using these very short depreciation tables, right? So there's a lady I do loans for. She owns skyscrapers in San Francisco. And I was like, wow, she has all this positive cash flow. How is she paying, this or whatever? And so, and I looked and I was curious, I typically don't do it, but I dissected the paperwork. Wow. Okay. This is what she's doing. So, and that's what they're doing. They're doing shorter depreciation, right? Where they're depreciating stuff over a short period of time, because then she'll 1031 out of it.
Buy something
Buy something bigger or whatever. It needs to be at least the same price that you sold for, right? But that's how she's doing it. And this lady is very successful, great lady, but very business savvy. And that's kind of the stuff that, so I learned from everybody. Just like I learned from you guys, I learned from other clients, and it helps you become who you are, right? You're always going to grow. Everyone's going to grow.
Yeah, it's crazy how you mentioned about like how the taxes work for real estate, because just about 2.5 years ago, before I got my first rental property,
Right.
I'm in a high income bracket. So they tax me at the highest, right? And I was like, man, how do I, there has to be like a legal way to like get around this, because Uncle Sam's taking half.
Right. Exactly.
and
people don't understand that, but the more you make it, you don't pay less.
Yeah,
you pay more.
You pay
Your
more.
percentage goes up.
Yeah.
Right.
So I was like, man, how do I fix this? And then when I started investing in real estate, bro, like the amount of money I've saved in taxes
Right.
is worth the investment, aside from the cash flow, the appreciation.
Right.
And then I also started learning about how taxes work. Because before, 3 years prior to this, I didn't know how taxes work at all. And I'm surprised, obviously they do it on purpose. They don't teach us in school, right? But that would be a great class to have. Imagine being in high school and learning how taxes
Oh, there's
work.
a lot of things that they should teach you in school that they're not, you know what I mean? But yeah, to do that, how to put your bills first, right? How to be responsible. There's a lot of things they should be teaching, but taxes is one. I agree.
Well, that's the biggest one.
Because when I started making money, I was getting those big tax bills every year, which I mean, knock on wood, we still get them, but now I know it's for what I pay, it's I've done my best.
Yeah,
you know what I mean?
exactly.
So
You can never really get away from it 100%,
Yeah,
but
right.
you can minimize it.
Exactly.
That's the key.
Right. And for me, it was just being naive and going out and having a good time and just paying taxes basically on everything that you made, but now once you start buying more and more rental properties, you can see how paper losses or this or that or putting money into your own properties, which you're not only gaining appreciation from it, right? But you're also getting the write-off of raising that cost basis of that property, right? So now you got more depreciation coming in, so yeah, it's a great tool. Real estate's a great tool to help mitigate I guess you could call it what you have to
Your
pay
risk.
Uncle Sam, right?
So like for a lot of our audience, right?
Right.
They're trying to get into investing. They want to learn how to invest into real estate. Like if you had to give like in your last 20 years worth of advice to someone, so that way they don't make the same mistakes as you did, right? If you could sum it up in like 2 to 3 advices, like what would you tell our audience?
That's a hard one because some of the biggest mistakes I did was I was approached by people that were who I would look up to and where I wanted to be, right? And that approached me to become a partner or become whatever. And I blindly didn't look into everything I should have looked into, right? Behind them or behind the investments. And they turned into huge losses. So I would say when you're going to buy something, especially if it's a partner, somebody you may know, somebody you may not know, look into it. Make sure it's something that you can get yourself out of, right? Don't get trapped into something where you're paying everybody else's bills, right? Just be careful. Do your due diligence. You know what I mean? Like make sure you're not walking into someone that's just using you to get to their goals, right? Make sure that you're doing your homework. Make sure like your due diligence. Do your due diligence. And if I could say it in 2 words, or a few words, it's do your due diligence. You know what I mean? Look into it. Make sure it pencils out. Make sure it's something you get out of. Make sure it's something that this guy can't rip you off on. You know what I mean? Because my biggest mistakes were all different large home builders.
You know what's crazy, bro, that you're mentioning that is I literally thought of one of my friends. So this guy, he's a high earner. He put 100 something grand with this guy that like is an investor. And he put his money into like a year and a half to 2 years where it's locked up. It's a certain percentage. By the end of it, within the next, it's been like over a year. He hasn't gotten a penny back in interest because it's all in one, right? And I remember when he came up to me, he's like, hey, what should I do? And I was like, don't do it. And then I told him, I was like, the reason why is because, bro, you can make way more money if you invested that money yourself, right? That's one. Number two, bro, you're going to wait and have your money sit in his account.
He's making money. He's making money off of your money.
Exactly. And he didn't listen to me, bro. And today, when we talk about it, I'm like, dude, like I told you this. And on top of that, you don't learn how to invest yourself. You're basically saying, here's my money, do what you want. But you don't actually learn how to invest. You don't learn how to deal with tenants. You don't learn how to deal with like city codes and all that stuff. And to this day, like he kicks himself.
Yeah.
Right,
what I've learned is like a lot of the guys that are like your bigger home builders, they think they're the smartest guys in the room. They think that they can do everything and not use any of, like basically do huge developments, but they're going to risk their investors' money, but they don't have a dime of it invested themselves. So when I say do your due diligence and you're putting your money in with an investor or a partner, make sure see what they're doing also, because if they're coming into it with
no money out of their pocket.
With nothing, then I mean, look into it. You know what I mean? Because I made a lot of mistakes, and I wish I could go back. You know, and I would, if I could turn back time, those are the mistakes I would stop, is investing with people that I thought were where I wanted to be, and I thought it would jumpstart me to where I wanted to be. But in each of those times, it was always a mistake. I would walk before you run, right? Take your time. Make your own mistakes, right? Because you're going to learn from them. It's only a mistake, and it only sets you back if you don't learn from it. If you learn from it, it was actually a learning experience, right?
Mistake happened.
Right. There's a lot of things in life that are bad, but if you learn from it and you prevent it from happening next time, or you prevent it from happening a time that it could be even worse than that, right? But you knew that could happen. So because you invested your own money, right? And you manage your own project, right? So you learned that, hey, this could get really bad. So you look into that more. Like a foundation issue, it might look flat, right? Like the house looks flat. Oh no, there's no foundation issue because you're right. But you know, hey, I bought a house once and the foundation was so bad, it ended up costing me $100,000. I lost money in the deal because I didn't have the right foundation. I go look at it before I close the deal, right? So now they go in there, they'll level everything. They'll tell you what's sinking, or if you're still sinking, if it's something that needs to get fixed, and have and have it fixed right. Well, it's going to cost you this and what kind of warranties you're going to have, right? Because these are things that you can't control. You know, as an investor, you don't know what you're buying because you can't see through walls, right? So do your best due diligence, right? You know, and deal with people you trust. Yeah, that's my best advice.
It's cool because like, that's why I always do my deals with Eddie.
Right.
I mean, people are like, oh yeah, because it's your friend. I was like, no, you don't understand. Like the expertise alone, like right now you're doing 2 of my loans, right? One of them is a hard money loan with the construction loan, 100% of it, all that good stuff. I have no clue what I'm doing. And I'm literally calling Eddie up when I was, when I did the insurance, signing up for the insurance, right? I called Eddie. I had this guy on the phone the whole time. I was like, hey bro, yes or no on this question? He's on no. Yes or no on this question? And that's how I literally filled up the application.
I mean, Eddie's done it a ton.
Yeah.
Like even with Premier, what he's done, I mean, those guys have done a lot, man. So they're with everybody we have. They're at the top tier pro level with the biggest dogs in the nation, you know. So the experience that he brings is huge, you know. And this is the kind of experience you want to learn from because it's a good guy. He knows you personally. He's not trying to take your money, right? So that's different than some big home builder that comes to you and says, "Hey, do this because I'm going to build 1,000 homes and you're going to make $1 billion," right? Like those guys, yeah, it's different when you're building and you're walking. Because I would call these ADU stuff still a walk. It's a fast walk, right? And the more and more you're doing, it's still a fast walk. But the guys that are running are the guys that are doing 600-700 home projects at once, right? But that's the kind of money and the kind of money those guys got to attract from guys like us, right? Because without guys like this, they don't have anything. They don't use their own money. Those guys and those contract those guys use, even for the people buying their houses, I don't know how they get away with it, man. But unfortunately, a lot of the dirty people in this industry are the home builders. But that's another video.
Do not get with it. No.
All right, so we're gonna close it off right there. Thank you, Vic, for hopping on. Appreciate it, man.
Thank you for having me, bro.
Yeah, of course.
You definitely helped a lot of our audience for sure.
Yeah, I
You're
hope
spitting
so.
fire.
Make sure to like and subscribe, and we'll see you at the top.
That was solid, bro.
Fuck yeah, she was
I
solid,
learned a
dog.
lot, dog.